Great. It looks like everything's good. Okay, everybody. Great. So, thanks so much for joining. It looks like sound and vision is good. I'm just going to quickly go through disclosures, necessary evil that we have to do. The presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leverage products, they involve substantial risk of loss, and they're not suitable for all investors. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act, and contracts for difference, otherwise known as CFDs, they're not available for US residents because of regulatory reasons. Okay, guys, that should be that done. Oh, let me just double check. Can you still see my desktop? Yes, you can. Great. Okay. I'm just going to get rid of it. Oh, it is shared. Great. Fantastic. Let's just bring up my other charts and we'll get cracking. So as we've been on just live on this, we just had some slight disappointing Q2 GDP. It was revised. Was it disappointing? Let me just double check. Sorry, I'm trying to read it from a few different things. Let's see where it went. Bring this up in front of you guys as well. So as you can see, this was the PMI data that we had earlier this morning. This is the GDP data. So it was revised. That was pretty good. So the annual rate was actually revised slightly higher to minus 0.5%. So roughly in line with expectations. Household consumption slightly higher. Gross fixed capital investment, that's very good news. That was up in positive territory rather than negative territory. So even though it's still very weak, it's good news because investment suggests growth further down the line. Government expenditure was also slightly higher. It's not fantastic, but it does suggest that maybe the fiscal screws are starting to loosen, and that's allowing some growth in. So maybe it could be slightly difficult reading, one could say, for some of the other for some of the more hawkish members of the Eurozone. And retail sales for July overall fairly weak, but I think, people are going to be concentrating on the PMI. The services sector was actually weaker. That kind of coincides with weaker retail sales. And then the composite level, still above 50 though. That is good news. We saw above 50 from Spain. Strong data coming out of Germany. Strong data also strong data coming out of Germany. France and an upward revision for France, but it was still in negative territory. And Italy was also the disappointment. So that's there. But what I really want to show you is this. So we're going to start with this. Oh, bear with me. I don't know if those of you who've seen a blue bow terminal before, but this is it. This is what I want to show you. And I want to go to the max. Because this is UK service sector PMI, as you can see, been on a nice upward trend for most of this year, but it's really accelerated over the last kind of 3 to 4 months. Someone did just mention the price tag for Bloomberg, and it is expensive. It's a fantastic service. So not really one for the professional traders I know, but it does do cool things like this. Not that this helps you, but it's just a nice way, since I have one, of showing you where things are going from a fundamental perspective in the UK. Strongest ever level in service sector PMI. Can you believe that, right? So at the beginning of this year, people were talking about triple dips. They were talking about another recession. They were talking about how bad the UK economy is. And now we're leading the world. Quite literally, we are leading the world. This here is the UK. As you can see, at 60.5, highest ever level. I just want to pull something else up to show you. This is China. As you can see here, 52.8. We are a nice bit higher than China. So, just bear with me one moment. The chart's not coming up. Sorry, guys. Let's see if I can pull one up here. No, I can't. Apologies for that. But basically, our data is running at a stronger pace than China. Who would have thought that? Not many people, for sure. So what does this all mean for the pound? Let's take a look at a really short-term trade, because we are already 30 minutes from that, or just over 30 minutes now from that release. As you see, nice jump higher, but we're getting stuck yet again around about this 156 level. It's coming as in shoots and spurts rather than like a really nice clean break through 156. Now this is an important level. Let's just go back to a slightly longer time frame. This 156 level is a big resistance level, of course. And if we just extend time frame even more, as you can see, overall over the past year, we're still very much in range-bound territory. 150. What it really means is that we are really trading we're still pretty much range bound, even with this excellent economic data. Now, obviously, tomorrow we do have a Bank of England meeting, and that's at 12 o'clock. No change expected there, but do keep an eye on our research page on forex.com. I'll send you the link there so you can check it out. Bear with me one moment. I'll just get that for you. It's not up there yet, but it should be in the next hour or so. And that will give our preview for the Bank of England report, and what we expect from that. We don't expect too much, but what we do expect potentially is a statement. And if we get that statement, from the Bank of England, remember this is kind of a new thing introduced under Carney. Is a good thing, is a new thing that we get under Carney. That could be what causes jolts and volatility in. And what's really worth watching out for is whether or not they stick to their commitment of QE, because obviously the economic data has just been getting better and better. And they got this commitment to forward guidance, to keeping rates very, very low. And the market is saying, hang on a minute, I don't believe you. I don't believe interest rates are going to stay low, until, 2016. I think you're going to end up actually hiking interest rates sooner than that. Firstly, they've got a knockout clause. I also think that they've got a knockout clause there, and they've also got one regarding inflation. Inflation is rising. We saw that in the manufacturing PMI. So as you can see here, Black Cat, you mentioned that the 200-week moving average is a good place to start. I agree with you, because we didn't get above there last time. Now, do you remember kind of back in June, and then again kind of middle of August, it looked like, we were above 157. We just couldn't get above that 200-week moving average at all. So how far do I think sterling will go? I think we could make another attempt at 157. Maybe to 156.50, say, but I think there's going to be a bit of nervousness putting more on right now. And that is because even though the market is challenging what the Bank of England is saying, at the end of the day, the Bank of England can still throw out more QE. And I think the limit today to sterling strength could come through, because potentially there may be a bit of an expectation that there could be some QE tomorrow. We think the expectation is very, very low, but that will affect, even if it's a low probability, it will still impact the market. Now, I just want to show you something else. This is the 5-year sterling swap rate. It's very good forward guidance for interest rates. So this, what this really shows you is that basically since Carney joined the Bank of England in July, we've really seen, so we had kind of a bit of a month two halves, but overall since he's joined, interest rate expectations have actually moved higher. If we go back 5 years, as you can see, interest rate expectations 5 years down the line, remember the 5 years Carney's overall term, are now at their highest level since kind of the end of 2011. This is sorry, someone's just said I don't get a chart like this with Bloomberg. You just have to type in, this is just the UK sterling swap 5-year swap rate. If you just type that in, it should come up if you do have Bloomberg. If you don't, then it's probably harder for you to get it, and that's why I'm showing it to you. Sorry about that. Basically what we're seeing here is that the market's going completely against Carney. You can see that with gilt yields as well. I'll just show you gilt yields here too. This is gilt yields post that stunning service set to PMI. They're now, so close to 3%. This is the 10-year. Why is that significant? 3% isn't very much, but it just really goes to show that basically UK yields are moving in exactly the same direction as US yields. So if you read my preview on the Bank of England report, which will be out later on that link that I just sent you today, then you'll read why maybe Carney's biggest risk is actually going to be the Fed. But I think for now, what that means, so yes, we've got rising interest rate expectations in the UK, but we could just potentially see a little bit of hesitation as we move into this Bank of England meeting tomorrow, just in case there is just in case there's a small chance that there'll be more QE. We don't think there will be. We don't think that the Bank of England will do that right now. Number one, because if we do get tapering later this month, and Treasury yields rise even more, that could push UK yields up even more. And the Bank of England may just want to keep its powder dry to act till then. So it may want to wait to grab the printing press until, potentially next month, depending on what's happened with yields. But, rising yields does obviously increase the chance of QE from the Bank of England to try and push them lower, because that's what the bank's aim is doing, or its new turn in monetary policy anyway. And that is having an impact on sterling. In terms of all where this, where we could go next, this is just the hourly chart. I do draw your attention to the fact that that's a bullish, momentum very much to the upside. And, obviously, the more we get towards 156, the more it opens. Let's just extend the chart a bit. The more it opens to kind of these highs here, kind of towards 157, the highs from mid-August. But I think it's certainly a good kind of stopping point is this 200-week moving average here, which comes in at around about 157.5. We just could not do that before. Yes, this is e-signal chart, someone just asked. So this is the 100-week moving average coming in right now at just around 156. Obviously, if we get above there, it does open the way to 157. Again, momentum definitely to the upside, but I could just see maybe just a little bit of nervousness ahead of that Bank of England meeting. So that's my overall. FX Roy, no, I don't agree that Trading Station by FXCM is the best chart. No way. Obviously, I'm going to say that. Okay, let's look elsewhere. So no mention of FXCM. Let's look elsewhere, shall we? Should we look at dollar yen? Massive week for dollar yen. Of course, massive week for dollar yen. Why is that? We got a Bank of Japan meeting tomorrow too. Remember, this is like the week of central bank meetings. It is totally the week of central bank meetings. We have so many. We've got about 5 or 6 tomorrow. We've got the Bank of Canada kicking things off later today. I'll talk about that in a moment later. But we've got Bank of Japan meeting, but then really on Friday, what's the most important data? Come on. I'm sure someone can tell me. Can someone tell me? I'm sure you can. NFPs, yay. You're all on fire today. Someone's just asking, is cable rising due to Vodafone M&A, 130 billion? Right now, it doesn't seem that likely. Obviously, some of that is obviously in cash, but 130 billion, we don't know the timing of when the money's going to come through. It may have a slight upward impact, but it's not really been enough to push us through major events, so we think it's going to have a very diluted effect. M&A these days, even at 100 billion pounds, or 80 billion pounds, it's quite small, for such a liquid play like cable. So that's one there. So obviously all eyes, are on the NFP, and that means that it's when it's NFPs, you've got to talk about dollar yen. And dollar yen, as you can see, nice move higher there, broken out of its prior range. Do you remember when it was getting stuck at that 98 level, that 98.80 level? It just absolutely shot through there, as you can see, through the 100-day moving average here, the green line on this chart. So where could we go next? Well, obviously 100 is a massive level that we're targeting, that is psychological, that the market may target. I mean, we're currently trading. We've retraced a little bit today. That would be, that would be expected. But we are just still clinging on to that 99.50 level. I reckon that any move back towards 98 could attract some buying interest into these non-farm payrolls. Now, the market doesn't expect a stellar reading. In fact, I believe the reading is 170. However, the average over this year will then be very close to 200 if we do get a 170 reading, and that could be what triggers tapering, which I know that Black Hat you've mentioned. So yes, so basically this is the last payrolls report before tapering, before the expectations of tapering from the Federal Reserve. So If we were to get the tapering in September, we think we're going to need a fairly strong-ish reading of PMI of NFPs. PMI crazy today from the US on Friday. But in the lead up to that, we are just kind of moderating just a little bit. I think, because we've got this Bank of Japan meeting as well, as you can see, this chart is, we've had a really nice move up here, real kind of acceleration, as I mentioned, through that kind of 99 level. And I think there was just, some people were pricing in the prospect of a dovish Bank of Japan as well. Dovish Bank of Japan combined with strong payrolls would be a very potent mix for dollar yen. So I think, the fact that we haven't got there yet, and this is just market expectation, that's really what's causing just a little bit of a sell-off. But I do expect it to be shallow. We don't expect yen to, absolutely decline. Certainly not in the lead up to that Bank of Japan meeting or in the lead up to those NFPs. Now tomorrow, there is expectation from the Bank of Japan. It'll be overnight London time, obviously, because it's in Japanese hours. At 7:30, usually Kuroda speaks. Now, if they don't mention or point towards any further easing, then we could see a bit more upward pressure on the yen, which could just have some downward, or the effect of that could be just some more downward pressure on dollar yen. So again, we do think the losses will be cushioned though, and will be fairly shallow. Maybe 50, 60 pips, maybe back down to that kind of 98, 90 level, 98.80, which is the 100-day moving average. But we don't think it would extend too much from there because there's just too much expectation then around payrolls. However, if the Bank of Japan is very dovish, then we could actually get above 100 and we could move into the payrolls reading with dollar yen above 100. So watch out there. This is one of these weeks when there's so many fundamental risks, then what you need to do is get yourselves an economic calendar. Make sure you know what you're targeting. So, for example, if you're looking at non-farm payrolls, then maybe you just want to look at one pair. Sometimes, it can be quite volatile, quite choppy. For me, that pair would certainly be be dollar yen. Likewise, if you're looking at central bank meeting, maybe tomorrow you'll look at the Bank of England, and then that will, focus your attention on cable. Obviously, what you have to do in that environment is just make sure you know your levels and make sure you know what's coming up. And then kind of, decide whether or not you're going to react, trade the actual data itself. That's quite a risky strategy. Make sure that you keep your stops pretty tight, or if you're going to wait for the dust to settle. If the dust settles on, say, Friday afternoon, and we've come out of this week with stronger payrolls, the expectations are tapering, and a fairly dovish Bank of Japan, then I think that we can get back to these highs, these May highs, around about 103 in pretty quick succession. I also want to show you what, let me just create a chart here for you quickly. I'm sure those of you who've joined me before will know exactly what chart I'm creating. It's payrolls week, and I'm looking at dollar yen. What do you reckon? You'll get it now, I'm sure. And USGG, yeah. It's the dollar yen and the 10-year treasury yield. Just give it a bit of time to create. And as you can see, finally, dollar yen moving in line with it. So treasury yields have been moving higher. Dollar yen had been moving sideways pretty much. Now we're back in sync, basically, I would say. So again, if we see, another burst higher through 3% in this treasury yield, then that could really be what drags dollar yen higher as well. With all the risk events this week, I suppose you would recommend trading the relative small trades instead of big swing trades. As I said, it completely depends on your trading style. Some people want to trade very, very small scalping style during these, especially during the actual events themselves, as the market is trying to digest the information. That can be quite difficult to do because a payrolls report is not an easy report to read straight away. Other people will be looking at a much more long-term perspective and waiting for that dust to settle. In fact, a lot of people, especially the big kind of, the hedge fund guys, the big currency traders who you may, emulate to be, you may not. But those guys, they don't trade on payrolls day, right? They will be very interested in what's going on, but they're not going to be putting on big positions just to get the 20, 30 pips, because basically it's a very risky trade. We've seen it before, right? Whipsaw action, in across all crosses basically, but particularly in something like dollar yen with NFPs. And there's just so much uncertainty, and central banks really are, dominating central banks really are dominating what's going on at the moment. And I think when we're at this kind of, important stage, for me anyway, I would rather place trades and think about positions after the dust has settled, so after the event has occurred. Purely because my brain just can't process stuff that fast. But if yours can, then well done. You're incredibly intelligent, and those people will be, I would certainly recommend small trades though. And again, use opportunities too, of course. Euro, that's another one that we have to look at. Why? Because there's an ECB meeting tomorrow as well, as if that wasn't enough. And Euro, people are pricing in a dovish Draghi. This is the daily chart. As you can see, we're finding very good support here. This is a key level, guys. This is the 200-day moving average, which comes in around about 131.40. Oh, I'm sorry, 131. 131.40. 200-day moving average. That's where we're managing to find some support right now. I draw your attention as well to the daily MACD. It's not really telling us too much, but the momentum is on the downside. Looking at it from a much more shorter term chart, we are just finding a base here around about 131.5. Just ahead of that key level, that key 200-day moving average level. So that's no surprise. That's a big level. But the fact that we've just fallen, quite consistently, the market is maybe it's been mollified, it hasn't even really been mollified by the better PMI manufacturing data. The services data, it wasn't fantastic, but at least it stayed above 50 for the overall Eurozone. That's been kind of, that's kind of, what we're looking at. I still see Euro dollar, maybe the same as Jack, being very much range bound. I don't think we're going to necessarily get below 130 unless we get some big surprise or some big sovereign risk. I still see it as trading between 130 and 135. Now, if you guys can just cast your mind back to February, I know it's quite a long time now, but that was when Draghi, Euro dollar was trading at 137. Do you remember that? Those days? We haven't been back there since. It's here, these days here. We haven't been back there since, and one of the reason why, the reason why we haven't been back there since is because Draghi was like, no, this currency is too strong. We don't like it there. The mid-range is like 135-ish, and that's the kind of level that they like. So right now, 130 to 135, I think they're comfortable with. Anything below there, and it risks stoking inflation. Germans don't really like that, even though in fairness, Europe could do with a bit of inflation these days. CPI is the target's close to 1% now rather than 2%. It's closer to 1% rather than the 2% target. Jack, you've mentioned 130.80, a very significant level as well. 130.80, let's just remember it here. That was a big sticking zone, around about kind of the May, June level when we bounced off those sub 130 lows. Again, we've tended to trade in very much kind of in just in waves. And I just see kind of maybe 134.50-ish, being the high for now, medium term high. Someone asked me another question, sorry, on Syria. Sorry, I didn't see a question on Syria. If someone wants to write me one, please do. But Jack, I think you're right, like 130.80, middle of the range, absolutely, that's going to be a very important level. It was a sticky level there in June. And just as you can see, I would expect a bit of hesitation though around about this 200-day moving average. That is also, significant. Let's take a look at the cloud. Those of you who follow us closely will know we like the clouds here. As you can see here, we are approaching quite a key level, this 130 level as well, which again coincides with that 200-day moving average. That is the top of the daily Ichimoku cloud. Below there, we're at the end of an uptrend. So again, I would expect, around about kind of 130 to 131.40 for that to be a very sticky level. But it all does depend on Draghi. If he drops some sort of bomb and some sort of dovish bomb and sounds particularly dovish, then we could see it easily through there and then back to that 130.80 level, back towards 130, key psychological level. But looking, I can't really see us getting sub 130 anytime soon. I just don't see why. Obviously, a lot of it will also depend on the US. If we get a very strong payrolls reading that really supports the dollar, then that could be what pushes the euro down. That could be what pushes us down to 130. But at the moment, that's just a bit up in the air. So I think it's difficult to make predictions about that now. Okay, right. Rafiq, you've just said, oil, is it ranging or going down? What's our view? I think it's going to be ranging. I don't think it's going to be going down anytime soon. Now, I'm going to look at Brent. Brent and WTI, they've been moving roughly in the same direction. Largely because of what's been going on with Syria, and this is the wrong piece. Let's get Brent. For me, this is a big change, a big shift for this is a big shift for oil. Just taking a look at Brent, just trying to read through this chart. Most of this from June, July, August, most of August anyway, we were trading in a range between 105 and 110. And then we got above there. And there were two reasons why, guys. Don't just think of Syria when it comes to oil. Also think of Libya. And the reason why with Libya is because it produces very high-grade quality oil. And it's been absolutely delayed by a shutdown in production. Production has just basically ceased because of strikes, some attacks on some oil fields. And that happened at the same time that Syria happened. And that's a potent mix. So there's two strains when it comes to oil, geopolitical events that you need to look at. Syria, even though tensions calmed, they're on the rise again right now because of obviously the potential for the US to go back in. But we peaked at kind of just below 118 last week, when there was a lot of uncertainty around whether or not there was going to be a unilateral strike. Then we moderated, but we didn't moderate that much. We fell off by $3, and the reason why was because of what's going on in Libya. So read those papers, look at the kind of the back pages of the FT where the oil section is. They're giving you great updates on what's going on in Libya. That's what people like me are looking at. We are because Libya does produce such good quality oil and does export a lot of that to Europe. When you get a problem with Libyan oil supplies, then it causes upward pressure on the benchmark like Brent. So that is the reason why, and that's probably the reason why the downside is kind of limited. And I see that being limited for now. Obviously I think the supply demand is a weird one because you've got the developing world growing again, but then you've got emerging markets declining or growth levels declining. So you're getting a convergence. And overall, because emerging markets have been so important in global growth recently, that probably means that global growth is going to slow. So that should be oil negative, certainly mildly anyway. However, obviously geopolitical tensions are keeping us high. So I don't see us getting back to 110 anytime soon, but I see that as being the low. Maybe say 110, 111, and then the upside, obviously 120. Jack, I agree with you. If this crisis in Syria turns into a real nightmare, and a bigger crisis and it spills elsewhere to Iran, whatever, then yes, one would expect oil potentially to go through 130, 120 towards 140 to 150. So the question, this is a good question as well. Will there be tapering if the US gets involved in Syria? Good question. It depends on the timeline of when they do it. If they haven't done it yet and we're still in the same position, then I think there could be tapering. If they do it and it causes excess volatility in the market and causes excess geopolitical risk, then I think that they may choose not to. They may just choose to step back. And then where would that leave us? That would leave us expecting, just in this waiting game that we've been in all summer, just delay the waiting game. Okay, tapering is going to happen. It's going to have to happen. If the market can take Syria in its stride and doesn't think there's going to be excess problems elsewhere, then essentially we may be okay. So Pam, does that answer your question? Even with good NFPs, yeah, I believe Syria is part of that equation now, definitely, especially if it goes elsewhere. Okay, everybody, I want to quickly have a look at two more things. I know I've kept you late, but these, by the way, are Bloomberg charts, not e-signal charts. They don't represent our prices here at Forex.com, but we'll look at them at the moment because they're up. So as you can see here, this is Aussie. Aussie's done fairly well. RBA sounded a lot less dovish than they have done in the past. We got through a very British development here. We got through that 50-day moving average at 91.05. Getting stuck a little bit at 91.50. And potentially this kind of 92.20 level is the high, which is the top of the range from mid-August.
We would say as well that the Aussie is likely to be very sensitive to tapering, so strong NFPs could really see a decline in Aussie. So if we get back towards that 92 level, I think that's going to attract some selling interest, because tapering is bad news for high yielding commodity currencies like the Aussie. Kiwi, yes, I'll have a quick look at Kiwi. It's moving in a similar direction. Again, you know, the Kiwi's place in the FX spectrum as a commodity currency, meaning that we potentially could see some weakness there as well if we get a strong NFP. So this is the level that everyone's watching on the resistance on the top side, 78.93, just below that 79 level. Above there does open the way to kind of 80, which we were trading above 80 not so long ago. But I think it's, you know, as I said, tapering is bad news for commodity currencies, and since Kiwi is in that block, it could potentially wait. So I think any movement back to 80, to this 80-30 level, the 100-day moving average, could be met with some selling interest. And I just want to have a look at the CAD as well, because Bank of Canada meeting today, not expected to do anything. Be interested to see how the new governor of the Bank of Canada, he was expected to be pretty dovish, but he's not. He wasn't dovish in his first meeting. Whether he is later, as you can see, pretty much stalled, not been able to get to that 106 level, trading around about that 105 level. If he does drop that hiking bias, then we could see back well above 106. If he doesn't, then we could see to the bottom of this range here, which comes in just below, kind of around 104.75, and then below there, obviously, there's 50-day moving average here at 104.15. Is everyone tired with the yen? I would say that the yen and what's going on in Japan is kind of secondary news at the moment, because what's going on in the US with Syria, geopolitical issues are really driving the yen. So, for example, if we get Syria, that could actually be quite negative for dollar yen, to limit that upside, that break above 100 that we expect, because obviously the yen is a safe haven. Okay, guys, I'm going to leave you there. I've run over. I'm sorry about that. I hope that I answered all of your questions. Thank you. We were in great voice today, and please do join us next week for more, when we'll be back at the normal day, so normally on Tuesday. But thanks for joining, and also for being so good to join on the second day.